You've probably seen headlines like these. OpenAI signs a $300 billion epic contract. Nvidia commits to a $100 billion investment. Oracle stock skyrockets 30% overnight. These numbers are staggering, suggesting that artificial intelligence is ushering in a golden age. But in reality, this money never actually leaves the same circle. OpenAI promises to pay Oracle $60 billion annually for cloud services. Oracle immediately turns around and invests $40 billion into Nvidia chips. And then Nvidia pumps $100 billion back into OpenAI. It's like three people standing in a circle passing the same $100 bill, claiming to create $100 of economic value with each pass. What's even more stunning is that OpenAI expects to bring in only $12.7 billion in revenue this year, while losing $9 billion, with losses projected to balloon to $47 billion by 2020. How does a company hemorrhaging money year after year promise to spend $60 billion annually? As America's growth story becomes increasingly dependent on this numbers game, we have to ask, is this the eve of a technological revolution, or a Ponzi scheme that everyone understands but chooses to keep dancing to? September 2025 brought a deal storm to the tech world. On September 22nd, Nvidia announced it would invest up to $100 billion in OpenAI over the coming years. The next day, OpenAI announced its collaboration with Oracle and SoftBank to launch the Stargate AI infrastructure platform. With the Oracle partnership valued at over $300 billion, encompassing roughly 4.5 gigawatts of data center capacity. These announcements sent Wall Street into a frenzy. Oracle's stock soared over the following weeks, inflating founder Larry Ellison's net worth enough to briefly crown him the world's richest person. But if you're the type who likes to dig deeper, you'll quickly notice strange connections between these deals. Oracle needs massive hardware purchases to fulfill the OpenAI contract. According to the Financial Times, Oracle plans to spend approximately $40 billion on Nvidia chips, including about 400,000 of the most powerful GB200 chips. That $40 billion happens to come from advance payments or financing commitments received from OpenAI. And Nvidia is not just Oracle's supplier. In October, the company participated in OpenAI's $6.6 billion funding round, officially becoming an OpenAI shareholder. Going further, Nvidia's $100 billion investment will be paid in stages, with funds released as each gigawatt of data center capacity is deployed, and these data centers happen to be packed with Nvidia's own GPUs. This means a significant portion of the money Nvidia gives OpenAI will flow right back to Nvidia through purchases of Nvidia products. Following the money trail, the picture becomes increasingly clear. Nvidia invests in OpenAI, OpenAI pays Oracle, Oracle buys Nvidia chips, then Nvidia reinvests in OpenAI. This isn't normal business between three independent companies. It's a carefully designed closed loop. Each company simultaneously plays three roles: investor, supplier, and customer. Money continuously circulates within this circle, and with each rotation, it creates new revenue, investment, or orders on everyone's books. The circle keeps expanding. OpenAI obtains Nvidia systems through CoreWeave. And one of CoreWeave's largest investors is, you guessed it, Nvidia. OpenAI has also signed approximately $90 billion worth of chip procurement agreements with AMD, and as part of the deal, AMD granted OpenAI up to 160 million stock warrants, potentially equivalent to 10% of AMD's total shares. This means OpenAI is no longer just AMD's customer, but will become one of its major shareholders. The buyer becomes the seller's boss. This kind of role confusion is almost unimaginable in the traditional business world. Standing at this point in September 2025, a question began circulating among Wall Street analysts. Bespoke Investment Group wrote in a report to clients, if Nvidia has to provide the capital that becomes its revenues in order to maintain growth, the whole ecosystem may be unsustainable. But this question quickly got buried under announcements of new deals. Sam Altman recently revealed in an interview, "You should expect much more from us in the coming months." So why does this loop keep turning? Understanding how this game works requires grasping a counterintuitive business logic. In the AI era, companies with bigger losses often have higher valuations. OpenAI expects to lose $9 billion this year. with losses swelling to $47 billion by 2028, not expecting to break even until 2029. Yet this continuously money-losing company achieved a valuation of $500 billion in its September funding round. Behind this peculiar phenomenon lies a sophisticated financial engineering system. Traditional companies raise money based on profits. AI companies raise money based on the future. Investors aren't buying current profitability. They're buying the story that the first company to achieve AGI, artificial general intelligence, will dominate the world. As long as this narrative doesn't collapse, OpenAI can keep bleeding the capital markets, using new funding to fill old losses, using tomorrow's money to pay today's bills. But even the most aggressive investors need to see some substantive progress. That's the real purpose of these $100 billion deals. They're not about creating profits. They're about creating the illusion of growth. Every money flow gets recorded as revenue, investment scale, or order volume for each party, driving up valuations. Oracle announces a $300 billion cloud services order, and its stock soars. Nvidia announces a $100 billion investment commitment, and analysts raise their price targets. OpenAI showcases massive infrastructure build-out plans, and the next funding round closes smoothly. Every participant gets rewarded in the capital markets, even though actual economic value creation might be negligible. The fuel for this system is debt. Oracle's debt-to-equity ratio has skyrocketed above 500%, meaning the company carries $5 of debt for every dollar of assets. Total U.S. corporate debt has hit a historic high of $13 trillion, with a considerable portion flowing into AI infrastructure and chip investments. These companies aren't building the future with their own money. They're making a massive bet with borrowed funds. Nvidia CEO Jensen Huang candidly admitted on CNBC, OpenAI doesn't have the money yet to pay for all this equipment. He estimates each gigawatt of AI data center costs $500 to $600 billion. So where does the money come from? From investors. Where does the investors' money come from? From belief in the AI revolution. Bain's annual technology report reveals an even more stunning number. The AI industry needs $2 trillion in annual revenue by 2030 to complete planned data center construction. But even factoring in all cost savings from AI, there's still an estimated $800 billion funding gap, a 40% shortfall. This isn't a minor budget overrun. It's a fundamental problem with the entire industry's business model. But as long as everyone believes AGI is just around the corner, the game continues. Nvidia gives money to OpenAI, OpenAI gives it to Oracle, Oracle buys Nvidia chips, and everyone convinces themselves they're building the future. Money circles round and round, balance sheet numbers look prettier and prettier, debt piles higher and higher, while actual productivity growth lags far behind expectations. Even deadlier physical constraints are closing in. Morgan Stanley analysis indicates U.S. data centers will consume 57 gigawatts of power between 2025 and 2028, equivalent to 5 New York Cities' worth of electricity. But power infrastructure construction timelines can't keep pace with capital's frenzied speed. Even with unlimited money, you can't build power plants fast enough. This exquisite financial alchemy has one fatal premise. Enough people must believe AI will eventually make big money. But when we shift our gaze from Silicon Valley's funding news to America's actual economic data, we discover a deeply troubling split. If you only watch the stock market, you'd think the American economy is living in a golden age. Tech stocks hit record highs. AI company valuations inflate. Wall Street analysts continuously raise price targets. Since 2025 began, estimates suggest over 92% of America's economic growth comes from AI-related spending. This number gets quoted repeatedly as proof that AI is propelling the economy into a new era. But if you look at employment reports, corporate profits, and consumer confidence, you see a completely different picture. The U.S. Department of Commerce Bureau of Economic Analysis reports that in the first quarter of 2025, after inventory valuation and capital consumption adjustments, corporate profits dropped by $118.1 billion, a decline exceeding 40%, the largest drop since the fourth quarter of 2020. This plunge happened before tariffs, officially took effect in April, just after the February tariff proposal announcement. Businesses accelerated import speeds by 42.6% from January through March, frantically stockpiling inventory to cushion future costs, leading to strained cash flows and collapsing profit margin. The employment numbers tell an even clearer story. In June 2025, although unemployment fell to 4.1%, this mainly resulted from labor participation rates sliding to 62.3%, meaning many people stopped looking for work and simply exited the labor force. Of the 147,000 jobs added that month, half came from government sectors, with private enterprise job creation notably weak. By February, ADP small non-farm data showed U.S. businesses added only 77,000 jobs, well below the 140,000 expectation, the lowest level since last July. Average people's feelings are more direct than the data. The New York Fed's August 2025 Consumer Expectations Survey shows consumer probability of finding new work within 12 months after unemployment plummeted 5.8 percentage points to 44.9%, hitting the lowest level since the survey launched in 2013. This despair spans all age, education, and income groups, with confidence collapse particularly pronounced among those with high school education or less. Year-over-year growth in retail and food service sales slowed to 3.2% and 3.9% in May and June respectively, showing notably weakening consumer momentum. The Fed's June Beige Book report noted that half the regions reported slightly weaker economic activity, with most surveyed businesses and households adopting wait-and-see attitudes due to economic and policy uncertainty, making decisions more cautiously. These are two Americas. One exists in Silicon Valley's funding news, Nasdaq's candlestick charts, and AI companies' valuation spreadsheets. The other exists in factory shutdown notices, unemployed people's resumes, and consumers' wallets. The first America celebrates $100 billion deals while the second America worries about next month's rent. Even more ironic, AI technology's actual effects lag far behind the hype. An MIT study found that 95% of AI projects failed to generate any additional profits for businesses. IBM Watson Health was touted to revolutionize healthcare, but after repeatedly giving dangerous advice like recommending aggressive cancer treatment for what turned out to be just a mole, it was finally shut down, burning a $4 billion hole in the company's accounts. Economists observe a strange phenomenon. Soft data, like consumer confidence indexes and PMI, shows improvement, but hard data, actual consumption and business spending deteriorates. People say they're optimistic about the future, but their actions show them tightening their wallets. This split usually signals some degree of self-deception. While AI giants pass around $100 billion checks, the real economy supporting daily life is stalling out. When 92% of growth comes from a few companies' capital expenditure loops, what's happening to the other 98% of Americans? The answer's written in employment reports, cold numbers, consumer confidence indexes, historic lows, and quarterly reports showing corporate profits cratering 40%. This split can't last forever. History tells us that when capital market prosperity disconnects from economic reality to a certain degree, correction is inevitable, painful, and usually sudden. The only questions are when and how. The year 2000 dot-com bubble offers a cautionary comparison. Back then, the Nasdaq index soared over 400%, stayed at those heights for nearly 2 years, then crashed almost 80% between 2000 and 2002. That era was full of similar circular deals and vendor financing. Tech companies loaned customers money to buy their own products, creating phantom demand. When credit tightened and the loop broke, thousands of internet companies vanished within months. But this time is different, not because the risk is smaller, but because it's much bigger. If OpenAI or other major AI companies collapse, investors will panic and pull out. Thousands of AI startups will be forced to close, and shockwaves will sweep across the entire American economy. The 2000 bubble mainly affected tech stock investors. This bubble is deeply embedded in the entire financial system. Pension funds, university endowments, sovereign wealth funds are all heavily betting on AI concepts. When these companies' valuations implode, trillions of dollars will evaporate instantly, affecting every ordinary American invested in the stock market through their 401k retirement plans. Even more dangerous is the debt scale. U.S. corporate debt has already broken through the $13 trillion historic high, with a considerable portion flowing into AI infrastructure construction. Oracle's debt-to-equity ratio exceeds 500%, meaning debt is 5 times its assets. When revenue expectations fall through, these debts will become the straw that breaks the camel's back. Massive defaults will trigger credit crunches, with impacts reaching far beyond the tech industry. Will the government bail everyone out? Almost certainly yes. The 2008 financial crisis playbook is already written. When systemically important companies face collapse threats, the government intervenes to prevent domino effects. The Treasury injects capital, the Federal Reserve provides liquidity, taxpayer money pours in to stabilize markets and avoid total economic meltdown. But that's exactly the core problem. Every bailout sends a signal. Play big enough, and failure's costs get socialized. OpenAI CEO Sam Altman drives a car worth over $10 million. Oracle founder Larry Ellison briefly became the world's richest person because of these deals. Even if OpenAI goes bankrupt tomorrow, they won't be the ones paying the price. Executives have already cashed out part of their equity, exercised their options, bought their mansions and yachts. The people paying the price are those who never played the game. Those struggling in the job market with confidence in finding new work hitting 12-year lows. Those watching corporate profits crash 40% while wages stagnate. Middle-class families whose retirement savings are tied to the stock market and will suffer heavy losses in a crash. Taxpayers who will foot the bill for the next bailout. This is what economists call moral hazard. When you know the cost of your mistakes gets borne by others, you become more reckless. The 2008 bailout established a precedent. Banks learned the too big to fail playbook. Now tech giants are playing the same game, just with bigger stakes. Capitalism theoretically optimizes resource allocation by rewarding success and punishing failure. But when the punishment component gets systematically removed, when the biggest risk takers know the government will backstop them, the whole mechanism breaks down. What we get isn't innovation-driven economics, but cyclical bubble inflation, bursting bailouts, and reinflation. Sam Altman recently said in an interview, "You should expect much more from us in the coming months." This isn't a promise of technological breakthroughs. It's a preview of the next funding game. When an industry's survival depends on constantly finding new money sources rather than creating actual value, when CEOs publicly announce more deals instead of better products, the ending is already written. Maybe one day, a real AGI breakthrough will arrive and prove all this chaos was a necessary price for the future. But the more likely scenario is when debt can't keep rolling, when investors suddenly wake up, when power supply physical limits get exposed. This castle built on circular deals and debt leverage will come crashing down. And those who created the feast will have already positioned themselves for a clean exit. From OpenAI's $300 billion contract to Nvidia's $100 billion investment pledge, from Oracle's stock surge to AI companies' ballooning valuations, behind these dizzying numbers lies a simple and brutal truth. This isn't capital chasing innovation. It's the same money circulating between a few companies, creating the illusion of new economic activity with each lap. You might use ChatGPT every day and think AI really is changing lives, making those $100 billion valuations seem reasonable. But what's supporting this free service isn't a sustainable business model. It's an unprecedented capital game, using tomorrow's funding to pay today's losses, using debt to build infrastructure that's hard to profit from, using circular deals to pump up each other's valuations. When 92% of America's economic growth comes from AI spending while corporate profits crater 40%, when ordinary people's job-hunting confidence hits 12-year lows while tech stocks keep hitting new highs, what we're witnessing isn't the birth pains of a technological revolution, it's a dangerous split in economic structure. Maybe AGI really will arrive someday and prove all this chaos was worth the price. But history tells us the more likely script: bubble bursts, system collapses, government bailout, Ordinary people pay the bill, while those who drove the game have already cashed out and left. From 2000 to 2008 to today, the script never changes. Just bigger numbers and higher risks. One thing's certain, this time, nobody can say they didn't know where the risks were.